Okay, hey guys, I wanted to take a quick moment here to go over an extremely important concept, probably the most important concept for discretionary traders, and that is environment recognition. When you understand what current environment you're in, that helps you make the decision for what style of trading to apply to it. Because a really common mistake for most retail traders is probably not recognizing the difference between the two styles of trading that they should be applying, and they probably only apply one. And then when you apply the wrong trading style to the current environment, that's when your setups don't work. So, jumping straight into the simple concept I wanted to introduce first, which is recognizing what your macro trend and your lower time frame trend are. Those are going to help you with your positioning and your bias, so it's really important to recognize those two things first before you do anything. Then from there comes the most important part of this, which is recognizing what current regime you're in. The two environments that you can be in are ranging and trending. There's the only two. This logic applies whether you're working on a weekly time frame or on a 1 minute time frame. Same concept that you're going to constantly transition between a trend and a range and then back to whatever you started as. So when you are, the thing that you do is you recognize what you're in and then you keep playing it. So when you recognize that you're in a trend, you're going to go with the trend and you're not going to fight it at all. And you're going to be constantly monitoring for when the trend is weakening. Because when the trend starts to lose momentum, that is when you're going to start to transition to range trading, which is where the majority of discretionary intraday traders belong. It's much easier to have really effective systems for range trading. So now that the momentum has waned and you are transitioning to a range, which would be, like here, for example, you have lots of momentum, it wanes, you go into a range. When you're in the range, you want to trade it as a range. You don't want to anticipate that the market is going to transition back to a trend because you will almost always spend the majority of the time in a range. It's something like 80+% of the time is range trading, and then it's a much smaller amount of the time is the trending moves. So, like I said, when you're in the range, you continue to play the range until you're proven wrong. And really, the things that you want to pay attention to are when volatility is decreasing, as the range plays out, as price compresses, volatility goes down. You want to start to be a little more careful as vol drops off because as volatility decreases, you're much more likely to eventually get that uptick in volatility where you will get your trending move and break out of the range. So I wanted to go over this because it's extremely important that you, when you're in a range, that to clarify, I guess, you want to be aiming to do what's called mean reversion. So you want to be selling where price is expensive and buying where price is cheap relative to the range, and then taking it back to what's more fair value or where most people are trading. So you want to be buying at the extremes of value where it's the most cheap in the range, and then selling it when it gets back to the mean of the range, and vice versa. When you're expensive relative to price, you want to be selling it and then buying it back when you get back to where everybody else is trading in the range. As a range trader, your goal is to really, really pay attention to where value is and position when it is expensive or cheap. And don't be the guy that positions in the middle because that's what leads to your chop. So just the TLDR, right, guys? When you're in a range, you trade the range. When you're in a trend, you trade the trend. You're much more likely when you're in a trend to start to transition to a range than when you're in a range to transition to a trend because the majority of the time you're going to be range bound. So take that into account. And if you're an intraday trader, you should be majority of the time you should be a fader. To be honest, right? You want to be mean reverting mostly because the amount of setups that are you can replicate from mean reversion is a lot. There's so many more setups that can be created from that. But just to go over one little quick thing, right? Just looking at the basic price action here, right? We can very obviously see, that exact thing that I'm talking about. Whether you want to do the higher time frame where you want to say there's a huge range up here where we were trading above 60K, or you can do the lower time frame ranges where you can say this is a range that led to a trend, which led to a range, which led to a trend, range, trend, range, trend, pseudo range. A lot of the times when you get the things that look like ranges but they're failing, that's just price trying to identify if we can accept their and range. And then when you get a move like this where it attempts to mark up in range, it was trying to range within this area probably, and it failed, right? That's your rejection from value, and that's what leads to a trend. So anyways, I'm gonna leave it there. That is I really want to ingrain that concept into your guys' minds. So really think on this for a bit. Thanks, guys.